Okay, let's be real. When buying stocks and cryptocurrencies, most of us, whether accredited investors or regular players, we're in it for the gains. However, as long as those profits remain unrealized, our assets will be subject to the whims of the market. And when the pullbacks occur, which are more often in the crypto market, the majority, if not all, of your profits could easily be wiped out. But what if you could cut your losses in half or even keep the gains that you've already made? Well, there are several methods for doing so, but they are collectively known as hedging. So hedging is a great way to reduce the risk of negative market swings, either by limiting your earnings or losses. Well, in this video, let's take a deeper look at these tactics and how these instruments have grown into more than just an insurance policy, but also a vehicle for earning yield independent of market conditions. The old saying, do not put all your eggs in one basket, applies here. So if puts, calls, and other financial instruments are too complicated for you right now, there are far simpler kinds of hedging, such as diversification, which is also the most accessible hedging method for smaller investors. While minimum purchase restrictions and administrative costs can make investing in multiple asset classes expensive, the development of decentralized synthetic assets, or synths, has made it much simpler for regular investors and crypto enthusiasts to join in on the game. These derivatives offered by synthetics, for instance, are designed to mimic the price swings of the underlying asset and may be acquired in fractions through decentralized exchanges. So you can diversify by allocating your portfolio to various asset classes that are poorly linked or even inversely correlated with each other. For example, if you held some safer assets rather than a totally risk-on strategy, the relative stability of these safe assets would help reduce some of the losses you would have experienced if you had a portfolio of exclusively risk-on assets during a downturn. Now, while diversification is a more basic idea for most investors to grasp, quantifying how well your risk exposures are hedged may be tough. Certain derivatives, such as options, are preferable for a more quantitative approach to hedging. These instruments receive their value from an underlying asset. Their value will undoubtedly change in response to the price of that asset. So, call options enable you to purchase, and put options allow you to sell an asset at a preset price referred to as a strike price within a certain time frame. Options have gained popularity as a cheaper way to receive leverage without having to buy the physical asset, thanks to popular trading sites like Robinhood. The majority of individuals, however, are unaware that their primary objective was risk management. Okay, so for a more specific example, suppose that you bought 10 Ethereum for $2,500, and after a long time of hodling, your stack is now worth $2,900, a 16% increase. Despite the fact that Ethereum may hit a new all-time high in the future, you may be frightened that your hard-earned profits may be quickly depleted. So, to protect yourself, you may buy 10 Ethereum put options with a strike price of $2,900 for $865 each. Now, let's assume two scenarios. Keep Ethereum over $2,900, keep it below $2,900. If the price of Ethereum stays the same or rises until your options expire, you will only lose the money you bought for the options, which is $86.50. However, if the price of Ethereum goes below $2,900 during that time, you have the choice to either exercise the options to ensure that your Ethereum may still be sold for $2,900 or sell the options since they are now valued. Open, Deribit, Siren, and Premia are just a few of the many platforms available in the crypto sector for purchasing options. If you want to employ options as part of your hedging strategy, these platforms each have their own list of options to pick from, each with varying pricing, expiration dates, and fees. So be sure to check them all out. Now, futures and perpetual contracts, similar to options, can provide downside protection. The main distinction is that unlike options, both parties must fulfill the futures contract when it matures, whereas option holders are not required to exercise their option. So what are futures contracts? So futures contracts are standardized agreements to buy or sell a certain asset at a specific future date. Perpetual contracts, on the other hand, do not have an expiration date, as the name suggests. So Ethereum holders may follow the same strategy by keeping their spot positions while creating a short position at their target price using either futures or perpetual contracts, as in the previous example. So assume a short trade in Ethereum was launched at $2,900. If Ethereum falls below that price, the gains from your short position will cover the loss in value of your holdings and vice versa before any fees are deducted. And aside from that, you'll need to keep a watch on futures contract expiry days. You must sell the contract before it matures or roll it over if you do not plan to execute it. When you roll a futures contract, you are effectively prolonging the settlement term by closing the old contract and starting a new one, allowing you to remain protected until the next maturity date. In either case, these contracts are mostly reserved for well-known cryptocurrencies that are extensively traded on controlled exchanges. Long-tail assets are more difficult to hedge in this manner since most exchanges do not support their derivatives owing to a lack of liquidity. Decentralized perpetual platforms such as DYDX or Drift Protocol might nonetheless prove to be a feasible option for exotic asset derivatives. Now, due to the volatility of the crypto world, mastering the art of profit retention is equally as crucial as mastering the art of profit generation. To begin hedging, you don't need to be too technical or have an extensive financial background. Anyone could use DeFi's capabilities to access and execute various hedging methods on their own. Now, we should anticipate seeing a greater selection of supported assets as the demand for hedging grows in popularity within the broader crypto community. And also, the adaptability of DeFi's multiple Lego parts might possibly simplify more complex hedging techniques for the general public. However, this is merely the beginning and much more work has to be done before this fledgling sector of the crypto economy receives the attention it deserves. Now, if you'd like to stay updated on all things crypto, make sure you click the subscribe button, turn on the notifications, and also follow us on our socials for all the latest crypto updates. See ya!